I think we ought to just zoom out as an industry and say, is this the best product that we can offer users? Because by the way, it's not just the people that were 50x or 20x or 10x levered. It's, people that were 1 to 2 times long got liquidated.
The answer is we need better institutional infrastructure at the centralized exchanges, and we need to continued innovation at DeFi, right? And we need those things to exist together side by side.
This episode is brought to you by Blockdaemon. You'll hear more about them later in today's episode. Nothing said on Empire is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. What's going on, everybody? Welcome back to Empire. We got the Roundup. We got Rob. We got Santi. Rob, Santi, how's DAS?
That's great, man. I didn't see you there, though. Were you in London?
You guys both shook your head like it wasn't good to the side. You're kind of like, what's...
No, I agree with Rob. I saw Mike. I didn't see you.
Yeah, I'm just, puppeteering over here. What'd you think? What'd you think of the event?
Yeah, it was. So listen, it was a what I really liked about DAS, which I like about them all the time, is that you get kind of a different crowd, right? So, we were at Token 2049 3 weeks ago at this point, right? I'm losing my time a little bit because I'm traveling too much, but you get there and Token's probably the biggest conference in the space, but it's very retail driven. It's very heavy on the booths. It's very heavy on trying to get this excitement for the broader universe of what's happening in crypto. DAS is very targeted. It's got a really good set of people who are really focused on institutional use cases, really focused on kind of the enterprise adoption of crypto. And so I like coming because you get a different flavor, you get a really different type of conversation, and it allows me to really hone in on the types of people I want to see on that side of the world, especially when it comes to stablecoins, especially when it comes to tokenization, things like that. So I really enjoyed it. You guys put on another killer event.
Appreciate you.
Yeah. I mean, echoing a lot of that. I think what's useful now is gathering a crowd that is not crypto native, and it's good to see more and more of them coming and having those conversations. And obviously, there's a lot of excitement around stablecoins, tokenization. Rob and I were on a panel on talking about tokenization. I was in a panel with Hasib also talking. I think like every panel had a different title, and it all eventually, like all roads led to some flavor of tokenization, stablecoins, and that was, I think, a reflection of the times. The only thing that was a bit weird was the silent in the room. There was like in the main stage.
Yeah.
The silent disco was it was just eerily quiet, and you're like, am I seeing
Exactly.
people like?
So for people listening, like describe exactly what it was like.
So we're in a room of probably a couple, like 100 people plus or so, and they all are wearing these headphones with neon lights, and it is, I mean, you could hear a mouse fart in the room. You know what I mean? It was just too quiet, and you're sitting there, you're like, do people actually like what we're saying or not? And I've never seen it at a conference. You bet. You know what I mean?
We got a great events team. They try a lot of stuff. We try a new thing every conference, and you gotta try new stuff to make these events.
I will say it can work because there was no echo. Sometimes you go to these events and the acoustics are totally off, but that was a great event. I mean, Rob, you and I were in a panel. Who else was on that panel?
It was Paul
it was like
from
a TVL.
Yeah, it was Paul from Plasma and Simon Taylor from who's now at Tempo, right? And so ours was ended up very much being about stablecoins, right? And there's actually I'm gonna take that back for a second.
You were not on that panel. About corporate chains.
Yeah, ours was about corporate chains.
Well, we were both. I was on. How many panels were you on? 3?
I was on 2. I was on 2.
Yeah, I was on 3. Ours was about corporate chains, and they tried to peg a version of the corporate chain. I'm like, I brought my pit bull called Rob, and he defended me on stage.
Can you believe what I just did though? And I'm gonna give a little shout out. I just talked about my other panel, which was Diogo, Monica, and not Santi. And so I was like, it was Diogo, Paul, Simon, and me. And you know what it is? It's kind of the dark hair, the beard. So I'll give it to you. But then, so we did the stablecoin one, and then Santi and I did the corporate chains one with Andrew Peel.
Yeah. Morgan Stanley.
Ex Morgan Stanley. The panel that I really enjoyed, I was actually with Rob's counterpart Hasib, which was on the first day. We ended up talking a lot about what had happened that Friday. It's always good because we had that Black Friday event, which I think we should talk about in this podcast. There's a lot of really good insights that it was a very heated debate and discussion. We ended up talking about, what had worked and what hadn't worked, like the difference between Aave and Binance, what actually went on with Athena. Rob, I know you're super involved in Athena, right? Then you had Binance come after. There was a lot of things to
let's
unpack
go there
there.
now. Yeah, let's go there now because it feels like, I mean, the dust has settled a little bit, but we're 1 week after just it's really really large flash crash that liquidated a lot of people. A lot of people lost a lot of money. A lot of funds got really really hit badly. A lot of the exchanges got hit. A lot of individuals got hit. And really, I mean, I did a solo episode with Doug Colkett. So, if people want to get into the details, you guys should go listen to that. But I'd be curious, just like Rob and Santi, now that we're a week removed from it, I'm sure you guys had a lot of conversations about it at DAS. Like, what are your takeaways, conclusions, thoughts? Like, how do you feel like a week after and like the aftermath?
Yeah, so for me, it's something that I'm actually quite concerned about, right? And it's just a broader point around like microstructure within crypto, right? And so, in some exchanges, I mean, I think we saw Atom's like $3.35 today. On some exchanges, it hit like a fraction of a penny, right? You saw a lot of the alts were down 80%. You saw basically mass dislocation of pricing and depegging of all of the wrapped assets on Binance, right? Essentially, Binance's Oracle setup was not as robust as it should have been. You saw even Bitcoin was down, I think, about 15%. It almost about touched 100K, or so it had been about 120 beforehand. So, almost 20%. And one of the things that you really realize when you dug into the data a little bit is you essentially had this mass kind of liquidity vacuum, right? So as these, cascading liquidations happened, not only were, the stress of the sell side of the order book creating, kind of these continued, discount in pricing or decrease in pricing, and it also caused some of these like wrapped assets to have this dislocation in pricing. You saw that also the liquidity got pulled from the market makers. And so it kept coming down, and these like any sort of ARB, any sort of like filling up the order book, like just didn't happen, right? Talk to some of the market makers about it, and they'll tell you, well, there was just, it seems like there was just an issue for them getting new capital into Binance at the time. And so there was latency concerns. There were just concerns of congestion on them being able to get new capital into their account to continue to go ahead and kind of market make essentially. But it highlighted, I think, a little bit just how fragile the microstructure of crypto is today. It highlighted how fragmented it is when you see these really big dislocations happening between cross exchanges. And because of the way the liquidity dried up and because of the concerns on the market making side, you actually had ARBs cross exchange that weren't able to actually close particularly quickly. I think there was a $10 ARB on Solana across multiple exchanges that was open for like over 30 minutes, right? And this would never happen in typical equities. And then on top of that, I think other biggest concern for me is just how little like real buying pressure there was or liquidity there was for a lot of the alts, right? And so one of the things I've heard from some of the large traditional investors that I've talked to who, were in, Bitcoin and ETH and have been thinking about, they have a real interest in some of these, alternative tokens. Some of them have said, listen, like, going down 80%, even if it is temporary, and most of these things have recovered a little bit, but they haven't recovered, 100%. They've recovered maybe 50% of the loss. They're like, that's not volatility that we are able to stomach, right? Like that is not the type of thing, the asset that we want to trade that shows to us that maybe there is a lack of maturation in the market structure. And so, we don't want to actually go and end up, trading, that type of token on exchange. And so I have a little bit of concern what that conversation or what this implies about some of the liquidity dynamics and the microstructure dynamics. And I will also tell you that this has permeated into some conversations with regulators. It's permeated into some conversations with, some of the what I would say, more interested parties outside of crypto, right, as well. And, we have things that we have to answer. We have to get better, right? We have to have better Oracle construction. We have to have better liquidity management. We have to have better collateral management. We have to have more tri-party agreements. Like, we have to continue to get better if we want this space and we want these tokens to be traded by, the largest exchanges in the world.
Yeah. What I'll add, a lot of that is very true. I think it puts into question. My first reaction was like, hey, we're going to bring more real world assets on chain, because you saw like two worlds. Aave, flawless performance. Another stress test, flying colors, no bad debt. It actually made a bunch of money. I was with Stani. So it was able to absorb and a lot, like, that's just one example of more Lindy. So who wins in all of this? I think DeFi proved quite well. You could argue Hyperliquid also performed quite well. The auto deleveraging kind of thing that kicked in for the first time since its 2 years of operation, I think worked quite well. Some traders probably didn't know the mechanism, didn't read the fine print. But I will say, like, mechanically, Rob, I don't know if you would disagree, but it worked as intended. And however, Binance and some other exchanges didn't work as well. And that's where I think the reality is there's an over reliance on centralized exchanges in the industry. Um, and when you think about some protocols, like if you're pulling your Oracle price feed from Binance, like if your Oracle construction that relies on like centralized exchange price feed, I think you have to really sit there and think twice about how you're going to construct your Oracle and what is an accurate price feed for these assets, right? People should remember, just because there's a ticker that says, this particular token is worth $2, the reality is it doesn't mean you can actually execute size at that price. Most people, I think, realize that the order book can be super thin, very dry, really quickly. And so, anyways, there's a lot of fragility in the crypto market structure, but important to highlight the winners here. And I think a protocol like Aave performed very, very well.
Yeah, you can actually see we just launched a new dashboard. It was Aave's biggest week at 85,000 in liquidation fees. Their average is like, what are these numbers? 40,000, 50,000.
Mm-hmm.
Aave had a very big week.
And look, the last thing I'll say is people should go listen to that discussion that we had with it was Haseeb, Matt Hogan, I think, for Bitwise, and I forget someone else. Richard Muirhead from what is it? Ethereum, not Ethereal, Fabric. And I mean, users got liquidated going, because a lot of times, like, we understand if someone gets liquidated if they're going 50x levered, right? And Brian Armstrong, funny enough, had a tweet that Coinbase, was like, Coinbase now supports 50 times going long on your shitcoin of the day. It's like, I think we ought to just zoom out as an industry and say, is this the best product that we can offer users? Because, by the way, it's not just the people that were 50x or 20x or 10x levered. It's people that were 1 to 2 times long got liquidated.
Across 30 plus networks and 180 endpoints, Blockdaemon EarnStack unites staking and DeFi into a single institutional toolkit for crypto rewards. With multi-layered security, full asset control, and 24/7 support, Blockdaemon EarnStack is built for scale and regulatory clarity. Non-custodial staking and seamless DeFi access, all in one stack. Direct access to DeFi with no intermediate smart contract or vaults. To book a demo, make sure to click the link in the show notes or head over to Blockdaemon EarnStack to find out more. Thanks to Blockdaemon for making today's episode possible. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders. The first machine economy free zone is live in the Emirates, and it's all happening on Peaq, the machine economy computer. Head to peaq.xyz, that's peaq.xyz, to find out how you can benefit from the age of automation, or click the link in the show notes to find out more. As always, investments in blockchain technology involve risk, terms, and conditions apply. We have a friend who I won't mention his name, but he messaged me the day after it happened. He said Hyperliquid failed. I don't care what nonsense they preach. They sold our fund's 8-figure position. Pretty much an existential day for perps, in my opinion. Not sure how anyone can trade on them. We had 1.2x leverage on and liquidated us fully, which is insane. So yeah, if you're 40x levered, you that's the risk you take. But if you're you're levered up 1.2x.
I mean, but I was talking with this guy, and look, crypto's a volatile asset class. You just sort of assume that even an asset like Bitcoin can go down in 30% in 20 minutes. Like that should be your operating assumption. And so any leverage is a ticking bomb. The other thing more interesting is, that I don't know if this is actually true, but we should run the math. This guy was basically saying the optimal strategy is to go along the S&P 1 to 2 times levered. He's like, because it's not as volatile. But if you ran that and backtest that, you would have gotten liquidated at some point, because 1929 and 1988, or the savings and loan crisis, and then 2008. So even if this is the problem that we have with the industry, the default leverage on exchanges, on some exchanges, is 10x. Now that doesn't mean that everyone's going 10x long, but imagine if that's the default when you log in, and I appreciate not all users go there. It then is the anchoring of 1 and 2 doesn't seem that much, but the reality is if you're going even 1 and 2, you're going to get liquidated at some point.
Maybe the one thing I would point out is, our friend Yana, who you mentioned, I know who you're talking about. I will say that, he kind of, he put a, kind of a list of his positions, and they were all really long tail, right? So even though it was 1.2x, it wasn't ETH and Bitcoin and Solana and, even things like Hype, right? It was very long tail stuff for the most part. And again, I think it highlights the risk of liquidity right now that exists in a lot of the non-majors. And I think it's really important to understand here, or just, I mean, you had the podcast with Doug already, but ADL is very focused on what your risk is, right? So it is leverage, but it's also about the liquidity, right? And so at least on some exchanges, there was actually 0 ADL for Bitcoin and ETH, and there was only ADL and other tokens, right? And so I think it underlies the major issue. It's yes, there's too much leverage in the space, but we're not going to stop that. I think to your point, Yano, there was a conversation oh, maybe perps are done for. They're not done for, right? People are gamblers, right? It's just going to continue to happen. And maybe you'll see less institutional leverage, and that's probably a good thing. But a lot of what we define as institutional in this space anyways is basically just semi-rich people and, with small funds. But there will continue to be a lot of retail leverage. There will continue to trade long tail things, because that is just human nature. That is what we're seeing happen. But I think it underscores what we need, something different for the 90% of volume, right? If I go and look at Coinbase, right, and 80 to 90% of the volume is institutional and 10% is retail, but you kind of flip that on its head when it looks at their revenue, that 80 to 90%, that needs something better, right? And we need, if we're going to have all of the biggest, takers in the world come into the space, they need something better than what's happened. But I agree with Santi that, it's clear that, many ways DeFi, performed better than CeFi in this case. But I don't think the answer is that we're going entirely DeFi, right? Because I don't think, you talk to the institutions that are coming on chain, they're not there yet. But the answer is we need better institutional infrastructure at the centralized exchanges, and we need to continued innovation at DeFi, right? And we need those things to exist together side by side.
Yeah. Do you think that anyone has blown up badly from this? This is always the big question, right?
Well, you see the leaderboard in Hype. I think in Hyperliquid, I think there's a lot of large whales that got blown out, I would say, and liquidated. But funds, I was going to ask you, Rob, you guys don't, I don't think you, if anything, you don't put any leverage. And if it's leverage, you're probably putting it yeah, you don't trade. But I'll tell you, look, as much as I love DeFi, it is awesome to get a call from your counterpoint saying, hey, you get that margin call. It's pretty nice to get a margin call. And I remember like during COVID, you know, we got a couple calls that day. And it's nice to be able to have some time to refill collateral. It's not so nice to get liquidated by some mechanism that you may or may not agree with and how it went about doing it. And so I think
I
a
think
lot of
this is
people,
one of the controversies, though, right? Which is like,
yeah,
you know, so I give a lot of credit to Guy. I think Guy was extremely smart. People realized that it sounds like Athena had negotiated some of these like no ADL contracts. Oh, is
I
that
don't think
wrong,
that's true.
Rob?
No.
Oh,
No,
okay. Oh,
that's a
well,
thing that people, you know, have said on Twitter,
oh,
but
I
I
was
do not
giving
believe that
credit
is
to
true.
Guy. I think that's I was like, that's very savvy of Guy. Um,
But
but
you know, if I think there's a point here to be made, and sorry to interrupt, which is
yeah,
that like again, it's how ADL works, right? If you're not levered and you're in the most liquid tokens, you're unlikely to get auto deleveraged even in the worst of times, right? And so like what is Athena trading? They're just trading basis on ETH and
yeah.
Bitcoin. For the most part, there's a little bit of SOL in there, but it's mostly just ETH and Bitcoin, and they're not on leverage, right? And so like if that's the case, like the likelihood of you getting auto deleverage is like close to zero, right? You're going to be the last person in line.
So you guys don't think any of the market makers, like big, you know, big tier one, like big name market makers, or any centralized exchanges, or you're not concerned about that?
So I do know of for a fact a few funds that have gone under because of this or closed their funds. All of the ones I know are, you know, names you might not know, sub $200 million. There's going to be no systemic risk from them. There's a few of them. I have not heard of any real. I've not heard anything credible about anyone of real size that anyone would be particularly concerned about. Um, you know, I've talked to a lot of, you know, our friends at the, you know, the biggest market makers, the biggest trading shops who are all like, yeah, it was tough, but actually the rebound has kind of been okay. And we actually made, you know, we were able to trade around it a little bit and we're doing okay. It's not that bad. Right.
Yeah. Yeah. Anything else on this topic or move on?
I think we can move on. I do what I think
Yeah.
maybe it's worth highlighting. Wait, sorry, you want to go to Santi?
well, I was just gonna invite if you're a builder out there, I've had this idea for a while, but like, can someone build like the flow of getting a call from to refill your collateral on chain? Because like I could tell you a lot of funds when I was like, it would be a good functionality to express that in some sort of logic where there's a buffer, there's a time period. I think some protocols have like a mechanism where you have a like NFT protocols have like 15 minutes or like a couple days to kind of refill. I don't know actually if it's possible or not. My brain is not big enough, but like if you could if you could create a protocol where you have a little bit of buffer in there or some sort of mechanism, it would be interesting. Like I would actually be interested in investing in something like that.
I mean, even something as simple as, I mean, if you like right now, one of the problems is how do you get in touch with someone? It's just a wallet, right? So there's no email address or phone number connected to it. So even just the ability to opt in to connecting a phone number and email to a wallet would, like that. I mean, that's an addition.
Listen, I can tell you a lot of funds
Yeah.
have shied away from putting funds on chain because they are too afraid that
Yeah.
of
Yeah.
this
Yeah.
flow
Totally.
where the oracle fails and you get you're
You get
wiped.
licked. Yeah. Yeah.
Well, and I think it's important, right? Because like if we're talking about Athena, right? If a Oracle on chain had been referencing the curve pool, the curve was never more than 3 to 5 pips off, right? Resting liquidity on curve was higher for USD than it was on any single exchange, right? And the Oracle references Binance's order book, and the Binance order book, the actual resting liquidity there is actually very small, right? And because the USD had just been started to be supported as a collateral asset pretty recently, and so I think it's important that we need to be more thoughtful around Oracle construction. And I think to my point earlier, how do CeFi DeFi need to exist next to each other? It is actually really important though that we have DeFi. And I think the institutions are starting to understand that as well. It's just going to be some hybrid for the interim. But to Santi's point earlier, Aave performed really well. Hyperliquid performed as expected. I think there's a conversation around should they be a little bit more sophisticated in the way they think about ADL, right? But it's a little bit tougher because you don't exactly know how people are handling like basis or like net leverage, right? But I think there's a world where you can potentially make some improvements. But it's clear that when you have this transparent set of rules that is programmatic, like you just don't have a lot of these same kind of like out of the blue microstructure problems that just like completely take everyone by surprise, right? Like people are at least more aware often of what that risk looks like.
Yeah. All right, shifting gears a little bit.
One
yeah,
last thing here.
yeah.
One other thing to call out. Can you guys hear me?
Yeah.
Yeah. Look, there's a very clear divide between how Solana handled this spike in load and how Ethereum L1 handled the spike in load. And I will say again, it is tough when you're interacting the L1 and fees go up to a couple $1,000 and you can't get, So as much as I agree with Rob, like DeFi perform flawlessly, you just can't be in a world where you don't see a viable path going forward of increasing activity in an L1 like Ethereum when you have the congestion and the fee spikes that you have. And Solana, from everything that I saw, just didn't have this problem.
But people aren't even arguing that anymore. Like, I don't think anyone thinks things should happen on the main, on like the main, L1 anymore, right? It's all moving to base and L2s.
I agree, but I would say if you want to bring RWA, like I'm thinking about RWAs and that
Yeah.
type of like onboarding and like 5 years time, like because I've talked to a lot of folks that's like, hey, I don't want to deploy in L2. We're going to deploy in the L1 because the average of fees has been low over which is true, but it's like how the person drowned in a river that was on average 5 feet deep. Well, no, like in this world, you have to think about that spike in like what is the worst, and I think Haseeb made this point at the panel, which is if you just have to bake into your math that there's going to be a spike in load. And if that happens, a couple orders of magnitude, fees are going to go up the wazoo, and then you have to work backwards from there and say, hey, maybe we shouldn't be deploying the L1 because if we need to quickly do ADL or do these things, you're not going to be able to do it, and that has a whole set of implications.
Yeah, I will just say on that point, and I'm definitely not arguing for Ethereum mainnet as a place where we're supposed to be trading perps, right? But I think some of the L2s didn't have this problem either, right? And they were all fine as well. And if you actually look at like volume by protocol, like there's actually like on a relative basis for like Solana owns a lot of the trade and economic activity, but for perps, there's actually not that much happening on Solana on a relative basis, right? It is still very much like a spot market for certain types of tokens. A lot of the largest, or basically all of the largest perps protocols are mostly on other chains.
Across 30 plus networks and 180 endpoints, Blockdaemon EarnStack unites staking and DeFi into a single institutional toolkit for crypto rewards. With multi-layered security, full asset control, and 24/7 support, Blockdaemon EarnStack is built for scale and regulatory clarity. Non-custodial staking and seamless DeFi access, all in one stack. Direct access to DeFi with no intermediate smart contract or vaults. To book a demo, make sure to click the link in the show notes or head over to Blockdaemon EarnStack to find out more. Thanks to Blockdaemon for making today's episode possible. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders. The first machine economy free zone is live in the Emirates, and it's all happening on Peaq, the machine economy computer. Head to peaq.xyz, that's peaq.xyz, to find out how you can benefit from the age of automation, or click the link in the show notes to find out more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Related topic, but I want to keep talking about Binance a little bit. So this was in the so this guy CJ who runs Limitless, which is an up and coming prediction market on Base, I think it is. Posted his offer. So Binance has these listing fees, right? And he posted publicly the offer that he got from Binance, and this has kind of been a taboo topic in the industry, I feel like. So I don't know even how much you guys are open to talking about this, but I'll share what CJ said. He said, offer from Binance, 1% of the airdrop on day one, alpha listing, 3% of further airdrops in 6 months, 1% for quote unquote marketing at Binance, full discretion, provide 100% of the TVL for token pool on PancakeSwap, 250K security deposit, 3% reserved for BNB hodler program, 200K worth of tokens at MFN price for Binance affiliate marketers, 2 million BNB security deposit for spot listing, offer from Coinbase, build something meaningful on Base. So I think this is what he's really saying is, Binance is asking for like 10% of our listing, 10% of our FTV to get listed on Binance. And You see Dudas tweeted a similar thing. He said, confirmed with double-digit teams that they've received the same Binance token supply proposal for listing in TGE. Binance wants to take a nearly 10% tax from any innovator in the industry who launches a token. This is 10 times worse than TradFi. Enough is enough. Do you guys have? I'm curious, like even Rob, how you advise portcos to think about like the exchange listing process. And Santi, I know you've been through this a million times with other investments that you've made. I'm curious how you guys think about this. And will this dynamic change over time? And
Yeah, so I'll say two things. One is so the Binance, in my experience, the Binance ask for listing is actually extremely variable. So I know, Mike put that tweet out there that, they're asking for 10%. I in my experience, that's pretty rare actually. Now they do ask for, I would say, too much in most cases, and they ask for a lot. But the way to think about the listing teams at these exchanges, they actually have a lot of leeway, and they want to see the things that they want to trade listed, right? And so the more that it is a thing that they want to trade, the less the fee is, right? And I have seen people get on Binance who have paid zero fee, right? And that happens. And I have seen people who have paid 10%. And so oftentimes when you see these prices that are, call it closer to 10%, it is usually tokens that, these listing agents, at least whether they're right or wrong, feel that there's probably not a ton of demand for necessarily within their user base today, right? And they think that Binance adds a lot more value than the token itself adds to them. Now, that's not to say that there's a lot of in between 0 and 10, and we see a lot of people in that in between. And even I think even 5% is too much in my opinion. And so I think it's very clear that people need to be thoughtful about this. We have probably seen more protocols be, I think, at least putting it out there that like maybe they're thinking about not listing on Binance if that is the ask, right? And they're only listing on places that ask for less, right? I think what we see actually is more typical is like 2-ish% across a lot of the other exchanges, right? And a lot of that goes back to the ecosystem. A lot of that goes into some of that goes into market making, and so there are probably more than ever a lot of protocols asking, should I be paying a real rake like this for a listing? And a lot more, I think, than ever are making the decision, if that is the type of offer, not to do it. Now, I will add one thing to that though, which is that Binance is still 35 to 40% of the market volume, right? And so there is still, I don't think it's as clear cut as like, hey, we just don't pay this and we, hope that we get, volume elsewhere. Now, if you really believe in yourself, you don't pay it and you work over time and people show a lot of interest in your token over time, you'll get listed anyways. That's definitely absolutely true. And so there's I think a decision around, the sequencing around, if you just list elsewhere first, and we've seen that work. But I think it is still important to, at some point probably be listed at Binance, but it's also important to, not really screw over your token holders. And so there's definitely more of a discussion today than there ever has been. And we advise people to be thoughtful around that. We definitely don't advise people to pay 10%.
So I think the other analysis that you can look at is the IPO listing process and what traditional investment banks have historically charged and what they charge now. And it's sometimes hard to analyze, but like, clearly, obviously 10% of your token supply is a lot. And obviously investment banks don't charge, typically investment banks, when they do a roadshow and an IPO, they'll charge you kind of like 1 to 5% of the offering proceeds. So if you're going to raise $1 billion, like, Figure did, they're going to charge you 5% on the total funds raised. Very rarely now will they get some sort of equity comp, like they will get like warrants. That's sort of rare now. Typically it's, Rob, correct me here, but it's mostly for most deals, it's just a percentage of the total funds raised. And they'll, you'll hire them to build a book, to talk to market makers, to leverage their relationships, put their lead left, lead right, your JP Morgan, Goldman, great. You're going to be successful. So I think that's when you do the calculus, obviously, if you're going to go list in the traditional markets, you're going to try to want to work with the best. And clearly, there's no disputing here that Binance, to your point, Rob, has the most amount of users and liquidity, and it's important to be listed, right? There's no top 10, 20 token in crypto that is not listed in Binance. It's as simple as that. So navigating that, obviously, they're sequencing, like all the meme coins got listed because they just had so much flow that, Bonk didn't pay a fee, and Whiff didn't pay a fee to list, as far as I know. And so I think, like, to me, that's the real comp. Like, let's go look at the fees and the structure that investment banks, merchant banks were charging companies maybe 20, 30 years ago, and compare that against Binance. I don't think it would have been like crazily different, in my opinion. It's just like in the state of the market. But I will say, you could then, maybe to take a little bit of leeway, there's this thing called the IPO pop, which is these things, for whatever reason, don't seem to be priced efficiently. The average pop of US based IPOs can be, is, I think, anywhere from like 15 to 25%. That's a lot of inefficiency. Now, it's hard to do the analysis of like what would happen if you didn't list on Binance and what is the average pop or not. But I will say, if these terms are correct, the terms that you just put up, there is no pop. There's actually a lot of selling because those tokens are not locked. They can do whatever it is that they want. A lot of the airdrop will be dumped because it's not locked. And so I think, my brain just immediately went to that. Like, the only reason why you would want to list on Binance, and I think, look, every project can offer whatever it is to market makers and exchanges, to board approval and whatever. Make sure, if you're going to structure these things, lockups work well to really understand the alignment. And it has never served anyone well to give tokens that don't have as, if they're going to work for providing liquidity and reputation, marketing and all that, it's, create aligned incentives. That structure is not very aligned, in my opinion.
Yeah, I would just point out on the IPO side, it's usually typically like 4 to 6% of raised capital, right? And so, like, to your point, right, $3 billion company raises $300 million in IPO. It's 4 to 6% of the 300, and it's also paid in cash of the cash proceeds. So it's not like there's like sell pressure on the equity, right? Typically, now there is like some green shoe and there's some other things that exist, right? But it's not necessarily a dilution or sell pressure in the same way. I think, to your point, like, aligned incentives around lockups are really important. Anybody who participates in, an IPO who does take equity, and we're seeing also more of this equity get put into retail hands these days than we have through Robinhood and other brokers, right? And technically, the way it's structured is that your Robinhood, if you do participate in an IPO through like a Robinhood today, technically the way it's structured is like Robinhood is actually a counterparty, so they're the ones who are locked up now. But they do have a lockup, and so if I sell, or if the retail person sells their equity, Robinhood actually has to warehouse it back, right? Because Robinhood itself is not able to sell during that period of time. And I think that is something you could improve here, of course, which is that, like, Binance can kind of distribute whoever they want in their ecosystem, but Binance users have some sort of lockup, right? Or they at least contribute that lockup to those users. And so I agree with you totally that's important. I think a lot of the token incentives that we see that have, call it, they TGE and they immediately have, some amount of the token that's liquid for people who are kind of just speculating on the pre-market price is always bad, right? It's always misaligned incentives. It's anyone, in my mind, who is doing some sort of like, pre-listing, buying of a token or airdrop, or maybe not an airdrop, so I'll take that back, but pre-listing buying of the token, or pre-listing like sort of some sort of like lending or liquidity provisioning or whatever. All of those people should have some lockup, and I think in most cases they do today, but not in all cases, right? And so what you really want is you want to incentivize liquidity. You want to incentivize getting this token into the hand of as many retail users as possible, and you really want to incentivize this thing hopefully trading well and having good, liquidity and market structure, because that gets people excited and that gets people to continue to invest. That gets people to continue to hold. And then you don't have, a lot of this, volatility or, downward price pressure that we've seen. And I mean, if you look at all of the recent like high profile listings, right? You look at Pump, you look at Plasma, you look at 00, all of these things kind of like, they traded at, multi-billion-dollar valuations pre-market, then they kind of went up. And then, and then they kind of all like lost 50% or more, right? In many cases. Now they're trying to find their footing, but, I think, does that, kind of price action that way, does it make it harder for them to find their footing now as the market gets more sophisticated and as they start to find some, maybe floor price where people actually want to own that token?
I mean, that's the challenge here, that I don't think we're ever going to get rid of this liquid venture asset class that companies are. It's the only asset class where companies are actually going public sooner, way sooner. Whereas in the other part of the tech world, companies are not going public. They're taking too long. They're staying private, like OpenAI. I mean, you have companies that are worth 100 billion plus that are still private, and that value creation has stayed mostly concentrated. I don't know what the answer to, like, it ties into the market structure discussion, like, the low float, high FTV. In many ways, like you sort of, I wouldn't say sympathize, but you understand the issues that potentially a market maker and an exchange is going to have, right? And so they're in the business of protecting their book and their users, right? And so they're clearly going to negotiate, because what Binance, in their defense, have a very rigorous listing process that they will kind of ask for team wallets and advisor agreements, and a lot of that information in many ways is like what the SEC would do when you're going public. Like, it's thorough. Rob, I don't know if you would disagree with that, but from what I've seen, it is incredibly thorough. So I will say, at least from a consumer protection standpoint, I think it's quite positive. But from a founder perspective, from a team perspective, giving 10% of your supply, I'm not here to tell you that's good or not. That's your decision to make. But
It's not good. 10% is not good.
No, it's definitely not good.
Rob's
But
like,
I
I am
will
here.
say, and it tends to be the projects that have the least amount of traction are willing to pay the most, because
Yes.
it's more marketing game. However, I guess the point I'm trying to make is, if you're a team, you very likely want to go work perhaps with, I mean, I don't know, you guys are investors in other exchanges, Rob. Like, I don't think I haven't seen these terms in a while
No,
from
but Binance is
most other.
definitely, they're definitely the highest. And then some of the, I would say, exchanges that we talk about less, but even of the other kind of like large Asian exchanges, of which we're investors in a couple of them that are, in that top 5, they're not near, these types of numbers ever, right? Even on
Yeah.
the, and obviously Coinbase is and Kraken is it. And so I do think, to the point that Yano, maybe to get all the way back to the question that Yano asked in the beginning, I do think that this, type of offer is probably going away over time, right? This is not sustainable, and it's definitely going to come down. It's not going to be zero, right? It's not everyone's going to go to the Coinbase model.
In TradFi, it's not zero either. Like Nasdaq and NYSE charge money, right? You've got an upfront initial application fee. You've got the initial listing fee. You have an annual fee that I think you have to pay them. But it's like, hundreds of thousands of dollars.
And the last point I'll say is, it's difficult to do an analysis in isolation, right? And it's unfair to say, because the last 4 projects that were listed, went down 30%. I think that's more of a reflection of the tokenomics, more so, and the current market environment, and the high FTV, low float, versus what any market maker exchange may or may not do. I mean, the market is just, you're in that state where, most of these projects just, to your point, there's no liquidity for these type of tokens. And you just saw that last Friday. There's no interest there. So.
Shout out to today's sponsor, Katana. Katana is a DeFi first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion CAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms and conditions apply. Let's shift to a different topic I just saw come up, which is Tom Lee, who's the chairman of the biggest Ethereum DAT, obviously Bitmine, says that the DAT bubble has burst. And I would love your guys' take on this. And Rob, I know you've been involved in a couple of these and helping. I think you've seen a lot of the structure of many of these different DATs. But yeah, I would love your guys' take on this comment.
I totally agree. Right, like the reality was, I've been talking about this for a long time. The vast majority of the DATs had absolutely no reason to exist. I think we saw, we started to see the SEC and the exchanges themselves. Sorry, not the exchanges, but like maybe some of the exchanges as well. But we started to see people start to push back on certain types of structures here, right? And so I think it was last week that the kind of canonical TON DAT got delisted on maybe it was Tuesday that happened, right? And it was because they hadn't gotten the appropriate shareholder approvals, right? This goes back, we talked before about Heritage Distilling. We've talked before about a lot of these other pipes where they took the perspective that they could kind of do whatever they wanted by stuffing a public company with as many tokens as possible in kind, as well as buying or raising cash into these pipes and buying these tokens, no matter the liquidity of the token, no matter like who it was from or what the type of the structure was. And you started to see a lot of pushback from the regulators and from the exchanges. Now, that doesn't mean that these aren't going to continue to exist. The regulators are going to continue to allow the ones that have gone through the appropriate approval processes. They're going to continue to allow the ones that are structured in such a way that makes it so we are clearly taking care of the shareholders, right? And are not doing something that has a lot of contingent liabilities, et cetera. I think the market is going to continue, or the regulators are going to continue to be very open to, and they're probably going to approve the vast majority of them, but they've really started to take notice for a lot of the kind of, I would say that the tail end or the shenanigans that were taking place in the DAT market. But then you have, the actual, and probably more what Tom is talking about, the actual traders of these things, or the investors. And one of the things that happened is that there were a lot of people that were looking at the premiums that all of these things were trading at, especially after Bitmine happened. And they were saying, oh, like this is structural, right? We can just go and put money into every single DAT that's run by a decent person and that's backed by a decent sponsor, and it'll structurally trade at some sort of premium and we'll make money. And so if we're already long whatever your token is, ETH, and then like, oh, well, structurally this, pipe into this thing will also mean that I get to be, I get to make more than 1 times my money. If Ethereum goes up, I make 1.2 or 1.5 or 2, right? What these people are realizing now is that liquidity can be a problem in the equity markets, right? And so all of a sudden, when these things,
surprise,
yeah, it's like people like completely forgot that was also these kind of highly illiquid micro cap equities also have that problem, right? And so they're starting to realize that there is actually no demand for the 5th Ethereum DAT or the 17th of Ethereum DAT. There is no demand for most of the Solana DATs. There is no demand for name your altcoin. Most of the altcoin DATs have no liquidity whatsoever. Maybe like the top one or the canonical one has liquidity, right? And so they're starting to realize that microstructure actually matters there as well. And then you're starting to see the sponsors get really, I think, trying to figure out what's happening and how to kind of save, these premiums, right? I think we saw it was Forward Industries by shareholder vote decided to extend their registration going live. So they were supposed to, all the pipe investors were supposed to be unlocked. I think it was end of last week, or no, it was earlier this week. It was like Monday or Tuesday. And the sponsors of that deal decided to extend it for 30 days. Well, why did they decide to extend it? They decided to extend it because they didn't want Citadel and Jane Street and a lot of these other pipe investors to go and crush the stock at a time when the tokens have all traded down because of what happened last Friday, right? And so you're starting to see a lot of these kind of games being played because people are concerned about this liquidity problem. And so I think completely this is only the beginning of that story.
I mean, look, if the phenomenon of shitcoins is not only true in crypto, ladies and gentlemen. Go look at some charts in traditional finance, and I got pink sheets for you. Go look at those, and go look at those charts. Not too dissimilar from your shitcoin du jour. And so, look, the thing that I've issues with DATs, and Rob, I hear you. DATs are the structure is different from any. The nuance is different. The terms are different, right? However, it is an arbitrage game. Some people, like Sailor, can play it very well, can negotiate terms, and know how to play in the big boys table. Most other people don't. And when you're playing the big boys table, you're going to get eaten by a shark, like called Citadel, and called most of the maybe you've been on the front lines more than I have. The vast majority of people that are investing in these DATs are very sophisticated hedge funds. A lot
No, the
retail
vast
new
majority
money,
of people invested in these DATs
a lot of retail
are
coming
crypto
in.
natives. Yeah.
Crypto native, but like retail, but they're what I'm trying to say, people trading around DATs in a very systematic way are they're trading around them, not so much investing. Because like and that's the issue that I think is happening here, which is there's all these unsuspecting retail say, I miss MicroStrategy and I missed the first Ethereum DAT, and so I'm going to do the third, fourth, fifth, and I should make a levered return on my, if I'm long Ethereum, I'm going to go this. However, there's just a lot of trading around these DATs and very sophisticated players that are investing in the primary, and then they just know how to hedge and lock in a decent, profit or whatever. And that I think is just doesn't bode well. Like the ARB eventually goes away, and if you're not sophisticated enough, you're gonna get crushed. And ARBs never persist in perpetuity.
Yeah, I mean, I think one of the important things here too is like there's two different group of people. There's the people who are like the pipe investors, and there's the people who are buying in the open market, right? The pipe investors are interesting because you have really two groups of people who have done those deals. The vast majority of those deals have been done by highly crypto native funds who are like, I am long this asset already, and I think this is some sort of ARB or that will exist and it'll trade at some premium. The vast majority of crypto native funds, I don't know this to be true, I'm speculating, but I would guess 90% of crypto native funds who have played these DATs in a real way are actually underwater what they would be if they'd held spot, right, at this point, because a lot of these things are now trading at a discount, and also they've had some illiquidity, so they might have traded out or traded in, etc. Right. And the reality is I talked to a lot of these crypto native funds, and some of these guys are the smartest guys in the world when it comes to crypto, have absolutely no idea how to think about warrant dilution, right? Like they just don't, it's a different market and they're not as sophisticated in that market. And so we've seen, I think, some people kind of miss certain things about how these things are structured, right? And then you have the traditional guys who are investing in these things. And I've seen this firsthand, and I think we've publicly were behind and being helpful with the Avalanche AVAT debt that got announced a few weeks ago. We helped sponsor it because we're long Avalanche investors. We've been an Avalanche investor in every single round they've ever done. I've also been involved with the Athena one, same thing. We're very involved with Athena. And so I've talked to some of these investors, and when I talk to the traditional guys, there's really two types of traditional guys as well. There's the ones who actually are long-term buy and holds. They want to be part of the thesis of institutional financial market structure coming on chain. They want to be part of stablecoin growth, right? And they see this as a way to play that in a levered way, potentially, right? Then there's the Citadels of the world, and I'm not singling them out purposely. They're just a name that everybody knows, who are clearly playing a short-term ARB. Right, they think they can buy this thing, especially if it's coming at a discount to NAV, and then they can potentially hedge it out on the other side with a perp or something. And all those guys are all sellers on day one of the unlock, right? And what we've seen a lot of the sponsors or management teams do in these DATs is they've been making trade-offs between, do I want to be bigger, or do I want to have a more curated investor list? And if you're bigger, that means you're probably taking money from Citadel. And if you're taking money from Citadel, you have to understand that on the day it unlocks, they are dumping all of those shares, right? And that's just who they are, because that's just the reality. Tom Lee, who's been the most successful DAT CEO and DAT, or I guess he's not CEO, he's the chairman and the sponsor of that. He made the exact opposite choice, which was, I'm only going to raise $250 million, and then I'm going to go raise capital other ways. And then I'm going to do share buybacks to make sure that, this, when people are selling into it, that I have some like resting liquidity there. And so he's made the exact opposite choice of which a lot of the sponsors have, and he's been the most successful. So I think it gets back again to the idea around this is actually a very sophisticated game that I think a lot of people who were playing it were wholly unprepared or just had different incentives. They didn't actually care if these things traded well. They just cared if they were able to get it to market and clip some advisory fee or something.
All right, Rob. To round out this discussion, the tide has gone down. There's a couple of people that are naked. The music has stopped. Does the music come back? Who actually survives in this game? We talked a lot about M&A and DATs, right? Like maybe larger DATs, like absorbing underperforming like DATs. What's the do you agree that the bubble has burst, and is it over, or what in what reformatted, because markets have a memory of a goldfish, then they do it again and again and again and again. In what format do we see these evolve, and is there a path forward here?
And I don't think it's over. I think in the near term, we will get maybe one more DAT of any real size that comes to market. And when I say real size, I mean like over $500 million, right? I think maybe we'll get one more, maybe two more max. I think there's a lack of liquidity at the investors who are doing these things. People are being more careful. Some of them are just completely turned off altogether, right? And so I think the raising new capital into new DATs is mostly over for the short term, right? I don't think it's a long-term point. And I'll kind of, talk a little bit about I think the parallel here is SPACs, right? And we had this like SPAC boom in 2021 where all of these like companies who were not public ready ended up getting taken public. Many of them have completely traded down or gotten delisted and have not done well, right? But we've had kind of a bit of a resurgence of the best SPAC sponsors with certain types of companies, and they figured out how that market makes sense for certain types of people. I think that'll happen here as well. But I think to the SPAC point, a lot of the DATs that have been listed and that are trading, I think a lot of them will trade down until they probably just get bought out, and then I think there'll be just a kind of a thinning of the herd, essentially.
Shocking that you need to have an underlying business model to go public and have a viable business. You can't just list vaporware. But okay, the thought that I have here is like Chamath is back with a SPAC, so you're right about that. Is this a greater indication of the sign of the times? Like we've talked a lot about like, are we at the second stage of the cycle? How much we were talking about like, do we have 1 month left? Do we have 2 months left? Do we have 6? Never like, is this more, should we read more into this of like, okay, institutional demand may not be there. You look at Friday, you had these tail end of assets that just didn't have and have not recovered and just have no buying pressure. We talked a lot about institutions. The reality is they're only buying ETFs, and the flows are coming in to the majors, Bitcoin and Ethereum. We're gonna have more ETFs. How do you think like you guys have been out like talking to allocators all the time? Are we over the cycle? Like not just for that, but are we like just coming to an end on just the overall like parade?
I'm going to keep saying no, right? I just don't buy the cycle story.
People who are watching or who aren't watching on YouTube, listening on Spotify or Apple, missed Rob's like massive eye roll. I've never I just saw all the whites of your eye. Yeah.
No, but I listen. It's funny because we talked to the VC allocators and we talked to some of the liquid allocators, and the VC allocators right now are like, I don't know, the conversation is as constructive as it's been since pre-Luna, if I'm being honest, right? And so they're really thoughtful again around what's happening. We just had Polymarket announce a $9 billion deal with ICE like 2 weeks ago, right? That if you go and talk to the VC allocators, the people who have long-term oriented perspectives are saying, oh, this is this is the AWS time of crypto, right? We're now starting to get the infrastructure there that we're going to have the applications, right? And now we're starting to see the use cases, right? I'm at an event right now, and the reason I'm in a hotel is I'm at an event right now put on by one of the biggest asset managers in the world, where everyone here except for me and Paolo from Tether is a non-crypto person. And they asked us to come and talk about crypto, right? And I went into this room and I had a discussion with, there was probably 60 people in this room. I counted probably 20 billionaires in that room, people, the CEOs of the biggest funds, the biggest banks in the world, the biggest asset managers. And it was probably the most I felt behind enemy lines in a long time in terms of just like a lot of skeptics, right, for crypto. And I had a long discussion with Paolo around, why do stablecoins make sense? How are they going to reinvent financial market infrastructure? What is happening in tokenization? What are we seeing and hearing? And I will tell you, after that conversation, during the conversation, the moderator, who is the CEO of one of the largest news organizations in the world, said, "Who here owns what they would say 1% of their net worth in crypto?" And a room of 60 people, there was probably 8 hands, right? And so not that many people, right? But a few. And then after that conversation, a bunch of people came up to me who did not have their hand raised and said, "Listen, I understand what you're saying, and that sounds really promising. I want to see that succeed. We're retaking a look at that." I had a conversation with somebody yesterday who said, they run a multifamily office, and they said, we don't actually right now give any liquid crypto exposure to any of our families. We're now starting to think about doing that. What do you think is the right amount? And I said, okay, well, Morgan Stanley just said 4%, right? I think it could be as much as 10%. What makes you comfortable, right? And they kind of got through the conversation that maybe 4%, made sense for them. But it was, I will tell you, very much Bitcoin, ETH, maybe a Solana was where they were at, right? And it's very clear that all of these people at all of these large banks, all of these large asset managers see this now as an investable asset class in a way they hadn't before. But that doesn't mean that alts are going to trade well, because that is not what they are focused on. They're focused on the future of financial market infrastructure. They're focused on innovation at the tech layer, and then they're focused on Bitcoin, ETH, and maybe Solana, right? And that is kind of the whole focus. But they're coming into the space in droves now with people like me and people like my peers who, because they want exposure, they believe in that story. So I don't think it's over when you have those conversations, but I will tell you that they're not going to buy your alts, right? Maybe the VCs will. And then I've talked to several liquid funds over the last week since what happened on Friday, who were actually even maybe dipping their toes into alts. So these are traditional financial firms who had said, this market structure tells me that maybe I should not actually be trading those alts, and they've kind of regrouped in the majors. And so I think we definitely have these tailwinds, but I don't think it means that the whole market is going to trade off. There is going to be a lot of bifurcation between the haves and the have-nots.
So I heard it in one of our panels in DAS, Matt Hogan, who's was CIO or of Bitwise, and he says something to the effect of, we're talking about debating the hyperliquid and what had happened on Friday. He said, listen, most of the people who are putting new money in a crypto can't even pronounce Solana. And I think it's true, right? I mean, you're getting people off of zero, and they're gonna go to they're now starting to understand Bitcoin because it's above 100,000, and they're maybe starting to understand Ethereum, candidly, because of someone like Tom Lee, who was at JP Morgan before. And perhaps that's the only benefit of DATs in that regard. Hopefully the blowback of some of the fallen DATs don't really counteract, but sometimes because we're in crypto Twitter all the time, listening to podcasts and in our own kind of circle jerk, we forget that people again are finally now coming around to this idea that crypto is a legitimate asset class and it's regulated. And I think it's going to take maybe more time than what we think for them to really start buying into anything other than Ethereum and Bitcoin. And so going back to that, yeah, it's going to be hard to convince anyone to really have a long-term position in a DAT. And the reality is those DATs will not will not endure unless you build a viable business model. I'm not saying that Forward or something like that can't build staking revenue. And if you have cash flow, the market is going to wake up to that. The problem is you can't justify a premium today because that's not there now. But if you have a DAT that survives that discount and can build meaningful staking revenue and meaningful validator revenue and, you know, have infrastructure, some sort of infrastructure revenue come in, then the market's going to understand that and do a fundamental analysis on it. And so if I personally investing would actually look at some of these DATs that have a viable, competent team that is going to interact in DeFi and stuff like that. Forward seems to be, you know, perhaps well positioned in that sense. If it trades at a discount, yeah, I'm going to take a hard look at it. You know, not just because I like Kyle, but I actually think it's a viable, like, hey, yeah, I think these guys can actually pull it off. And you look at like validator revenue and you know, that's interesting for sure.
Yeah, all the stories we hear right now from, you know, call it the best performing ones or the ones who want to be the best performance are all that, right? So Forward's obviously been talking a lot about DeFi and validators. I think the AVAT, the one that we were involved in on the Avalanche side, that's been a big part of their story, right? And I think there's a lot of people starting to come to some sort of realization there has to be more than just the pocket of tokens. It's an access vehicle, but it's not just that.
Yeah. Yeah.
The last, also, crypto's going to have less patience from investors on not producing cash flow. You're not Amazon that can, you know, can wait until you launch AWS 20 years later to show profitability and still trade at a premium. If you're a DAT and you're an alt DAT and you don't have cash flow, you are going to get smoked.
Yeah, I agree with that. I have to jump for a client call in a second, but I'm going to speed run. Yeah, speed run a little bit of news. Erebor, Palmer Luckey's company, got OCC approval. Kraken acquired CFTC regulated small exchange for 100 million. Coinbase invested in CoinDCX at a $2.45 billion acquisition. And while we were recording, Ripple just announced a new acquisition, which is a $1 billion acquisition of G Treasury. This is a 40-year-old company.
This is a DAT, right?
This is not a DAT. This is not a DAT. G Treasury is a very legit company. They do corporate, they do treasury management actually. They've been around for 40 years. Yeah, they do treasury management for big Fortune 500s, Toyota, Subway, Goodyear, American Airlines.
Do you think they're going to do treasury management for crypto protocols?
I mean, I think this is look at what we've been saying. I think the look at what they did with the Hidden Road acquisition. Look at what they did with their stablecoin RLUSD. What this company does is they do a lot of like risk and hedge management where they help Fortune 500s manage exposure to foreign exchange risks, interest rates. They centralize and secure a bunch of corporate payments. I don't know. I've been saying this on Empire. It's kind of controversial, but I think Ripple's going to buy their way into a massive business here.
This is clearly a stablecoin play, to your point. And I will tell you, when I have conversations with corporates right now, the number one thing that people are bullish about in stablecoin use cases at large corporates is treasury management right now. It's cross-border payments, but treasury management is probably the thing that comes up the most at the moment. And so this makes complete sense for them. It sounds like a great acquisition. I don't know the company that well, but I'd have to learn more.
Yeah, cool. All right, folks.
We're going to skip content.
Skipping content of the week. We all content. But
Rob, you got a couple of flights lined up, so you better watch something interesting and then let us know next Thursday.
Double content of the week next week.
And I'm going to bring it, I promise.
All righty.
Thanks, guys.
Have a good weekend.